Sustainability is a concept at Credit Suisse which is not new. It's one of the six professional standards in the bank's code of conduct. It also is anchored in business decisions, in the management of our resources and the infrastructure, as well as our supply chain. Back in 1992, Credit Suisse signed the statement of the United Nations Environmental Initiative, environmental program for financial services companies on the environment and sustainable development. We developed an environmental risk unit, issued our first environmental report in the middle of the 90s, got our environmental management system certified, and so on. This environmental management activities culminated in our achieving the greenhouse gas neutrality for our operations in Switzerland in 2006, which then was achieved on a global level 4 years later in 2010. In terms of our commitments, beside UNEP, we are signatories to the Global Compact. We are also active members of the Equator Principles, the project finance standards for banks. Moving to today, where we are, our 3 business divisions all are involved in green business of some sort. In investment banking, we have the Power and Renewable Energy Group, which is very active, and I'm going to talk about them in a minute. We are active in carbon trading, and we also have a broad alternative energy research team. In the asset management division, we have the customized fund investment group, which is investing client money in primarily clean tech companies, but we're also one of the biggest asset real estate developers and managers in Switzerland, and there for a couple of years we've come out with a label, the Green Property label, which is based on sustainability criteria such as the siting, the location of real estate, the level of insulation and energy efficiency real estate achieves, the building materials that went into constructing a building, and so on. And we are now actively both developing and buying property that has been built according to these standards and provide that as investment to our clients. Finally, in the private banking division, you can imagine, as any major bank, we do have a broad range of investment products, primarily fund and index products that are focused on renewable energy, resource efficiency, that select their stock according to best-in-class principles, or that invest specifically on specific topics such as water, electric vehicles, and so on. And also the private banking division has its own research team on special themes and alternative investments. But it's only for 2 years now that the 3 business divisions and all of these units that are involved in, so to say, green business have started to collaborate and exchange views and information and ideas. This has been brought about by the Green Business Initiative, which really tried and has been successful in bringing together experts, representatives from the different groups in each of the divisions, and allowing them to share information, to create new ideas, to work on new products or financing services for our clients around the topics of renewable energy, clean technology, sustainable agriculture, and related sectors. If you look into more detail into the renewable energy team in investment banking, which I mentioned, this team was established in 2005. It's by now the #1 renewable energy financing unit, both in terms of the amount that has been financed, but also in terms of number of deals. Number one spot has been occupied by that team since 2007. There are a group of specialists that cover all geographic regions and most different technologies. Obviously solar and wind power, producers of parts for these energy sources, smart meters once we move into smart grid systems, that's going to be even more important, but also biofuels such as producers of energy from sugar and ethanol. Crucial here was that the renewable energy team early on occupied that slot, built up know-how on both technologies and markets to be able to understand what in a client business is actually technically feasible and also financially viable. And you can see some of the transactions, some logos of companies on the right hand of this slide. You will notice also two Swiss companies with Landis & Gyr and Meyer Burger mentioned there. And there was also a more recent transaction for Meyer Burger than the one mentioned on the slide, the acquisition of Roth & Rau in 2011. The second noteworthy outfit is located in asset management. It's the customized fund investment group. There more than $1 billion of money belonging to our clients has been channeled into clean tech. The team is managing 12 dedicated clean tech funds, but has also selected 24 clean tech co-investments in companies that are in different stages of development. So some are early stage, means higher risk. Others have already proven that they can establish their business model and are now growing and need capital for that. There's also partial ownership of the customized fund investment group with a specialized clean energy company in the US, the Hudson Clean Energy Partners. The companies into which this fund investment group invests are active in, for example, the recovery and processing of slurry from the silicon wafer production. They invest in wind power operators. An interesting project is going on by Solar Reserve, a Californian company, where they are building up a concentrated solar power project. And also STR on this slide here is active in solar panel encapsulation manufacturing. So this is what we've been doing so far. Both of these groups are noteworthy because also they occupied an important market space. They are number one or among the leaders. But we also were thinking of where should this go and what are the challenges the economy worldwide is faced with, especially in terms of climate change. So this is why we have worked together with the Worldwide Fund for Nature, WWF, on a joint research publication with the title of Transition to a Low Carbon Economy, the Role of Banks. And I'm happy to present to you some of the findings here, and we hope that these findings will also guide us as a bank on where to put our emphasis and focus going forward. It is clear and I think commonly understood that climate change will have major impacts on the economy. Banks are no exception. Details aren't clear, but we will have to prepare for a range of different outcomes. Moving to a low carbon economy, that is decarbonization, is both a major risk but also can provide business opportunities. Companies should place themselves to make use of these business opportunities. And also our calculations have resulted that in order to limit global warming to 2 degrees and to adapt to the climate changes that cannot be avoided, capital investment of between 700 and 850 billion US dollars per annum are needed until 2020. These are capital investment on the one hand into low carbon economy, that's renewable energy, that's smart grids to give you examples, investments into energy efficiency, both residential homes and commercial homes, commercial buildings, as well as into a low carbon transport infrastructure with, for example, electric vehicles. Now, 700 to 850 billion dollars per annum, that sounds like a big figure, and it certainly is. To put that into some context, it's twice the annual spend on oil and gas exploration and production globally, but at the same time it's 10% of the annual global infrastructure investment that's occurring, and it also represents just a little bit above 1% of world GDP. So putting this figure into context makes it sound a bit, or makes it look a bit less daunting. The major part of this sum, 650 to 700 billion, will have to be invested into mitigating, avoiding the climate from warming, and 50 to 150 billion be invested into adaptation to what is why aren't we moving quicker on that? Our research also has brought to light 3 types of barriers and uncertainties. They are financial, technical and structural. The financial barriers are that low carbon projects are often less attractive. One of the reasons for that is that in most parts of the world CO2 does not have a price. Another reason for that is also that in some parts of the world fossil fuels are still heavily subsidized. So the number we found is 300 billion US dollar per year. Low carbon projects are also often capital intensive because they are new, they are small scale, and because they are untested in many cases, they have less predictable revenue streams than conventional projects. The second type of barriers are technical barriers. These are new technologies, immature, in early stages of development, that can bring higher risk with them. Also in the general public, as well as in overall in business and society, there are lower levels of understanding of these types of new technologies and a certain unwariness, which also brings about for a bank the difficulty that the pricing of the technology performance risk is uncertain. Finally, the third type of barriers are structural. Here we have network effects. If you, for example, think of purchasing an electric vehicle, you need to be sure that there's a reliable, spread out network of charging stations, because otherwise you'll run out of electric fuel some way on your route and you'll be stranded. If you're a provider of an electric vehicle network, you want to know that there will actually be people buying your electric vehicles before you decide on investing into a big network of charging stations. So there are 2 uncertainties which condition themselves. Also here we have agency problems that have to do with incentives. If you think of a building, it is usually the owner of a building which invests in energy efficiency, but the beneficiary of energy efficiency is typically the tenant who rents the building, who may have lower operational cost, and therefore there's not really an incentive for the owner to come up with higher upfront financing costs. And yeah, there's the status quo bias, a certain inertia that prevents us from going ahead if still viable, reliable solutions are available. What can a bank do now to contribute to a quicker transition to a low carbon economy? We have found 4 ways where a bank can be helpful in bringing this change across. The first one is mobilizing new capital resources, that we would carry out direct placements on green projects and involve directly institutional investors who put their money into such projects. One option is to develop project bonds, something which has been more common up to the financial crisis. The issue here is the lack of insurance coverage that investors want to see for such bonds that have to be provided from either governments or insurance companies, and that currently isn't available. The third option here would be securitization, which has received a bad name, but would be a solution to overcome the problem that many low carbon investments are relatively small, in that sense that they are decentralized operations, smaller projects, and as such they would be less suitable for institutional investors. If banks could pool such small low carbon projects, small investments, into bigger ones and place them with institutional investors, that could be a solution to overcome that and to make such an investment attractive to institutional investors. The second type of contribution would be products that protect investors against regulatory changes. They could have a structure similar to the cat bonds, where certain nature events or catastrophes can be insured. This would provide investors with a financial protection against changes to the regulatory support mechanisms that are in place. For example, an abrupt, quick reduction of feed-in tariffs for renewable energy projects, as we have seen in a number of European countries recently. The third idea would be to build up distribution partnerships with technical partners, as a bank to collaborate with, for example, an energy provider, where then the energy provider and the bank could offer a combined technical and financing solution to a client that provides an incentive for the client to do energy savings, so that the client actually profits from less energy that is consumed. A similar idea could be pursued in clean transport. So a bank should or could team up with logistics partners, transport companies that operate fleets, and incentivize them to operate them with less CO2 emissions. The key change in the thinking that has to occur here is that one doesn't look at his business or project in isolation, but looks into building systems and system solutions for that. And the fourth area is for banks which are investors in quite big real estate portfolios, either themselves or with client money, that they increase the energy efficiency of these buildings. That can be done through gradual reduction of energy consumption, gradual increase of energy efficiency, or in the beginning when buildings are built or renovated with a higher state-of-the-art insulation. There are building codes, standards such as LEED internationally in the US or Minergie in Switzerland, so that going forward any new building that is built is planned, developed, built and operated according to such standards. Again, here we have the agency problem with incentive structures that has to be overcome, that also the party that is making investments into lower energy consumption, higher energy efficiency, gets a reward for that. So that's the thinking that is currently going on at Credit Suisse. If you want to know more, there should be these 3 publications on display. The one on the left, the last slide, is the Green Business Brochure, where we outline where our expertise are, what we have done with clients in the past and where we want to move going further. In the middle, it's the research report with WWF. Here you find more detailed explanations of the last 3 slides I presented to you. And finally, also in the hope of getting an agreement on RED, for example, in place in Durban, we have produced a publication on forests, also to commemorate 2011 as the International Year of Forests. All of these should be on display at the stand where you are now watching this presentation. So I thank you for your interest, and I'm happy to take any questions you might have.
Thank you very much, Mr. Bischoff. First comment, unfortunately we do not have your publication on display here. I don't know what went wrong, but that would have been very nice to have this, especially the ones you mentioned, transition to low carbon economy, and also the red one about forest.
Yeah.
But at least we do not have them on display here. Let me ask you a question. You mentioned the 3 barriers for decarbonized economy, namely financial, technical and structural. Do you think this is true for the whole world, or do we see some differentiation between continents?
I mean, these are very general barriers, and as such I think overall they are true for the whole world. Of course there are differences in the continents, that some continents have spent more money on renewable energy, for example, have advanced a bit more on developing and applying renewable solutions or low carbon solutions technically. We can think of Germany or Spain, for example, where it has been government policy to subsidize quite heavily renewable energy production, which has certainly helped to overcome some financial barriers and has reduced the technical and structural risks. But we still believe that these barriers are, even in the more developed low carbon markets, if it's okay to call them such, these barriers are still there and need to be overcome. So overall I would think that this is true for the whole world.
Thank you. question regarding the transition to a low carbon economy, because what is I mean, a low carbon economy is economical, sustainable as well. So the having less energy consumption, or having less use of resources, it means also to use less money to buy this. Why is so difficult, or why this problem of convincing countries, developed countries, to change to this, to invest more into a low carbon economy, because that will make anyway as well for the future a more competitive advantage, because then you will be already efficient once the energy cost will increase even more. So why it's so difficult to bring the message of do the change now, that we are still in time, and that we will be already ready afterwards?
Yeah, that's a very good question, and I think one around many discussions will evolve at the Durban conference. I think one reason for why it's difficult and why it seems that money has to be spent on this transition is that we don't have globally a price for carbon. So this means that high carbon technologies, fossil fuels, are economically more affordable than the cleaner, the future, the low energy technologies, and this creates a distorted market, also with what I said before, with subsidies for fossil fuel producers. Another reason may be that the energy prices, which you alluded to, Luca, we all expect them to increase, and they will increase even more once carbon costs are included there, but they're still not high enough that renewable energy is fully competitive. On the other hand, over the last few years we have seen quite a significant fall in prices of electricity generated from wind, from solar, geothermal energy, and there are new technologies that are experimented with. So I think we are moving into the direct direction where in a few years the renewable energy will be competitive and will be also financially the right solution.
Let's hope this will happen. Thank you very much once again, Mr. Bischoff, and we read you from a sunny place here in Durban, and wish you have some warm also in Switzerland. For the pleasure to have you with us, and see you again later. Thank you very much.
Thank you very much. Have a good evening.